You can model a company with flawless operations, a pristine balance sheet, and widening profit margins. But if the macroeconomic environment beneath it collapses, that individual business cannot outrun the damage. Analyzing firm-level decisions, like analyzing a company's pricing power, its production capacity, or its unit economics, falls under microeconomics. However, as the British economist John Maynard Keynes established, a government's adjustments to tax rates and public spending can drastically dictate the performance of these individual firms. Tracking these broader aggregate forces, national income growth, inflation trajectories, and systemic unemployment, is the domain of macroeconomics. If aggregate demand across an entire economy shrinks, consumers stop buying. When that happens, the most perfectly optimized micro-level business model will still fail to generate revenue. To prevent this, research analysts rely on a workflow known as the top-down diagnostic. Broad economic data enters the top of the funnel and filters down to inform the specific inputs of a company's profit and loss statement. The National Institute of Securities Markets syllabus structurally enforces this exact progression. You must master economic analysis in Chapter 5 before you can accurately execute the industry and company analyses in Chapters 6 and 7. Evaluating a stock without this top-down framework leaves you vulnerable to valuing a business based on mathematically precise but economically flawed assumptions. We construct this diagnostic using 3 analytical pillars. Pillar 1 tracks growth and capital flows. To measure the total scale of an economy, we use gross domestic product, the market value of all goods and services produced within a country's borders, and gross national product, which captures income generated by a nation's citizens globally. Analysts dissect these metrics using 2 primary methods. The expenditure method tracks how a nation allocates its capital, balancing total domestic consumption against aggregate investment. This chart visualizes the product method of calculating GDP, isolating specific sector contributions. In India, the service sector generates roughly 60% of national output at factor cost. Tracking these expansion rates help analysts identify industries with structural economic tailwinds versus those facing headwinds. Domestic growth also relies on the efficiency of financial markets. An economy must be able to convert idle domestic savings into productive capital that issuers can deploy. When domestic savings fall short, countries rely on foreign capital flows to act as a secondary engine for growth. This primarily begins with foreign direct investment. FDI represents long-term, sticky capital. It is physical money utilized by multinational corporations to build hard assets like factories, supply chains, and infrastructure. Conversely, foreign portfolio investment, or FPI, operates as hot money. These are funds injected directly into secondary financial markets to purchase stocks and bonds. FPI provides critical daily liquidity to equities, allowing markets to function smoothly. But because it is highly liquid, it is also highly volatile, often fleeing the country rapidly during global economic shocks. By tracking GDP along with these exact capital flows, analysts determine if the total economic pie is expanding, and whether that expansion is funded by stable concrete or flight-prone cash. Pillar 2 focuses on policy and price constraints. These are the macroeconomic forces that dictate what it actually costs a company to operate. Inflation poses a dual threat to profitability. It degrades the purchasing power of the end consumer, shrinking demand, while simultaneously inflating the raw material costs for the producer. To combat this, the central bank intervenes using monetary policy. When inflation runs hot, the central bank raises interest rates to cool prices. But these higher rates directly increase a firm's cost of capital. As debt becomes more expensive, profit margins shrink and equity valuation is compressed. While the central bank manages monetary policy, the central government governs fiscal policy, utilizing taxation rates and public expenditure programs to steer the economy. If a government runs a persistently high fiscal deficit, it lacks the available capital to stimulate growth through public spending when an economic downturn inevitably hits. Analysts must also track global factors, specifically exchange rates. Currency fluctuations immediately alter the unit economics of international trade. A depreciating domestic currency makes a country's goods cheaper to foreign buyers. This acts as a massive tailwind, driving revenue for export-heavy sectors like IT services and pharmaceuticals. But that exact same depreciating currency makes foreign goods more expensive to buy, severely penalizing import-dependent sectors that relied on purchasing foreign oil, gold, or raw materials. A company might project record-breaking sales volume, but inflation, interest rates, and currency values dictate the actual profit margins they are allowed to keep. Pillar 3 covers trend mechanics. This is the framework analysts use to separate short-term market noise from long-term economic reality. One of the most common errors in equity research is misidentifying a temporary fluctuation as a permanent structural shift in an industry. This graph isolates a secular trend, a smooth upward trajectory spanning a decade, driven by massive structural shifts. Wrapped around it is the cyclical trend, representing standard business cycle expansions and recessions. Finally, we overlay predictable, short-term seasonal fluctuations. To figure out exactly where an economy sits within that broader cyclical trend, analysts monitor trailing variables, checking for warning signs like sudden inventory buildups or collapsing commodity prices. To prevent seasonal trends from skewing their analysis, economists avoid quarter-over-quarter metrics. Instead, they rely on year-over-year, or YOY, growth rates. Comparing Q4 of this year strictly to Q4 of last year strips out the localized noise of a seasonal festival spike, revealing the true underlying pace of growth. By accurately isolating the correct trend mechanic, you ensure that you are modeling the firm's true operational trajectory, rather than projecting a temporary macroeconomic wave out into infinity. We now have 3 populated pillars: growth and capital, policy constraints, and trend mechanics. The data extracted from this macroeconomic framework serves as the mandatory input for downstream industry and company analysis. We map inflation metrics and central bank interest rates directly into our discounted cash flow models to accurately project a company's future cost of capital. We map the current phase of the economic cycle, combined with sector-level GDP data, to confidently project a company's baseline revenue growth. And we map exchange rate trajectories and fiscal policy restrictions to stress test a company's margin risks against geopolitical shocks. Executing a rigorous top-down diagnostic removes the guesswork from bottom-up equity valuation. As Warren Buffett frequently notes, calculating the intrinsic value of an asset means analyzing earnings alongside the external interest rates at the time of deployment. You must understand the environment the business operates within, not just the business itself. Ultimately, the job of a research analyst is to systematically map these macro variables. Doing so ensures your financial models reflect strict economic reality rather than isolated mathematical theory.